Hi, this is Mike Umscheid from Arxis, and today what we're going to do is have a quick dive into the changes for TDRs. And actually, I probably shouldn't call it changes because thank you, FASB, TDRs are finally gone. However, in FASB's ultimate wisdom, as you know, they never really ever get rid of anything. They just kind of morph it into something else. And that's what we're going to talk about today, is how they've kind of morphed the old TDR functionality into what we want to call basically modifications, and how they actually titled it was modifications of receivables to debtors experiencing financial difficulty. So let's talk about kind of what that means and how it's different. So first, TDRs are gone. Now they're not gone till after you adopt CECL. So this is next year kind of thing. So it's actually going to have to happen next year. So all for the rest of the year, your TDRs are still in place. Okay, so we know that. But what's going to happen next year once you adopt this new standard? So here's the thing. Remember, it's borrowers experiencing financial difficulties, which is really why you would ever have a TDR in the first place. So from a functional standpoint, that part's kind of the same. So keep in mind that what's really happening here is they've morphed this whole TDR impairment, all of that, into something which is now modifications of loans for borrowers having financial difficulty. And so there's really two pieces. The two pieces, and really quick, because this is a short video for this, the two pieces are, is the borrower having financial difficulties? Now, the way they've defined that is pretty broad. It means they could be in default, they could have already declared bankruptcy. It could be that if it's a company that they're going to be delisted, or even the point where if it's a corporation, maybe where you've done some projections or their projections show that they're not going to be able to meet the cash flow requirements. So maybe even on a projected standpoint where you believe they're going to have financial difficulties. So if you have to modify a loan where that's happening now, then the question is, number two is that modification more than insignificant? Now, this is the exact same wording they use for purchase credit deteriorated. If a loan is going to be purchase credit deteriorated, it has had a basically change in its credit risk that is more than insignificant. And that's a much smaller bar to cross. So think of it this way. It has to be, if it's a nominal change for a modification, even if the borrower is having financial difficulties, it would be out. However, if it's more than insignificant, then the answer is yes, it would be a modification. Now, at the end of the day, what does that mean? Because I said TDRs are gone. So what it means is you now have to track those loans on borrowers having financial difficulties that you did a modification, and you have to disclose those. And that sounds on one end, you're going to say, well, that sounds just like TDRs. However, it's not quite the same. First of all, there's no impairment. All that's gone. All these TDRs are still in your pools. Number two, as we think about that. So all that's gone. What do you have to do? Well, you have to track the modifications. But here's the real kicker. When you get into the disclosures are different. And what they've really said here is how do you want to see the disclosures? And the disclosures are the big part. So let me explain what they've done. You now have to show in your financials, if you do disclosure financials, and I'm sure this is going to hit the call reports too. I promise you it probably will. So you're going to have to disclose what kind of modification you did. So let's say you did an interest rate reduction. Let's say you did a term extension. Let's say you did a partial forgiveness of debt. Let's say you did a combination of those things. So you now have to disclose whether it was an individual change, a combination change, and then you have to disclose the effects. So here's what we're recommending. We strongly recommend that instead of using just a TDR code or something like that, what you do is come up with a new coding system. And that coding system needs to tell you whether it's an individual type of change or a combined type of change. And then when you get ready to do your disclosures during the year, you'll be able to disclose that. Now remember, some of those disclosures are the effects of that. So if you did an interest rate effect, how did that affect your overall income, or the income on that, or the average rate? If it was a term, how long did it extend the term? So there's a lot of different things you're going to have to do with this. So This is a big thing. Spend some time on it. Remember, the change won't happen until next year, but it is going to mean some process and some different changes you're going to have to do internally to do that. Now, ArcSys has some recommendations for you. We have a schedule we can give you on how to think about breaking it out and kind of a little policy thing we did for it. So if you need that, don't hesitate to contact us. All right, this is our discussion on modifications. TDRs are gone. Have a great day.